The Small Caps is partnered with the Australian Stock Report. Looking to make better investment decisions? Visit australianstockreport.com.au.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Hello and welcome to The Call. 10 stocks picked by you two experts, 1 hour. It is Friday, the 22nd of July. I'm Andrew Gagan. Good to have you with us. Our two experts for this hour, Luke Winchester from Merewether Capital and Claude Walker from Rich Live. Welcome to both of you guys. Luke, what's going on at an index level at the moment? It's been a positive week. I think we're up around 3% on the local market. You see that as being sustainable at this point?
I think so, Andrew. I've been a little bit more optimistic on the market the last few weeks. And the main reason why is it feels like a bit more rationality's come into the market. I mean, some of the selling, particularly through May and June, it was well and truly irrational at times. I think we've come into July, a bit more rational market. And what you've really seen is some responses to fundamental updates. I mean, Megaport was out the other day. It's not my favourite business, but that was a good quarterly update from Megaport, particularly compared to where the business had been in those previous quarters. And you see the share price spike up strongly. A couple of retailers, JB Hi-Fi and Dusk, came out with some good numbers. You've seen share prices react. So, when I see the market being more rational and responding to fundamental positive news and the other way around, that the negativity is tied to the fundamental performances of businesses, I get a lot more heart and it sort of gives me confidence moving forward that as long as you're investing in the right businesses, doing the right things, you sort of don't have to focus too much on what's going to happen at that index level because, the businesses will take care of themselves, and that's really what we need to focus on.
Yep. Okay, Claude, what are your thoughts then? Are you feeling more positive or negative at this point?
I guess I'm probably feeling roughly the same. I mean, it's nice to have my portfolio rebound strongly from the tax loss selling that we saw in the end of June, basically, all of June, really. So that's nice. And obviously, the reason that you stay invested throughout these bear markets is just because you never know when it's going to bottom, and you want to be holding some of those high-quality businesses for all the reasons Luke said. So you can't go in and out of the market when you feel like bearish or bullish because you'll just be wrong most of the time and transactional costs, and it's just not a sensible way to behave. But in terms of how I'm feeling about the markets overall, to me, only the minority of high-quality companies got down to levels where I thought their stocks were cheap in June, and I did a little bit of buying, but it didn't stay there long, and now we've rebounded already. And generally speaking, for the bottom of a big bear market, I would expect that stocks would stay in the cheap zone for a little bit longer, and even that I would be going, I thought it was cheap before, now it's really cheap, and that's the kind of situation you see when panic really sets in. So, yeah, I don't know if we have bottomed yet, but obviously the process we're going through at the moment will probably take, in my view, another 18 months to sort of unwind some of the inflationary impacts that are already sort of in the system, as well as then the second order effect impacts from having high interest rates and higher commodity costs, depending on how long that goes on for.
All right, well, let's see if there are any buying opportunities today, particularly at the smaller end of the market, which I know you guys always take a good look at. Our first 5 stocks for today: Camplify, Obsidian, Noumi, MSL Solutions and AFT Pharmaceuticals. Our stock of the day, it's a bit of a larger one. In the insurance space, IAG out with its preliminary financial year numbers, expecting a full year insurance profit of $586 million. Looking ahead to FY23, seeing modest volume growth and an increase in customer numbers over the course of the upcoming year, though it's warning of challenging operating environment with volatile investment markets and a high inflationary environment, of course. So what do our experts think? Claude, yeah, insurance. And of course, we're seeing more and more of these natural disasters, which is clearly impacting those insurers at the same time.
Yeah, that's exactly right. The main reason that I've not been enthusiastic about investing in insurance for my entire career as an investor is because I have an extremely long-term view, which is that actuaries at insurance companies are extremely smart and extremely good at modeling things, but the impacts of climate change and the associated extreme weather events are just almost unmodelable. I definitely think that it's a brand new challenge. Their actual job, their core bread and butter of how insurance makes money is by being good at predicting the risk that a certain thing will happen and then charging appropriately for insurance against that thing. And if that core activity is getting harder, then that means you're operating in an increasingly hostile operating environment. Now, there would be an argument that sort of said in the very long term that will just lead to some very strong companies that nobody else can do what they do, and that might be what happens. But for me, that just makes the whole sector unattractive because there's like a long-term headwind against the sector. More near-term, of course, in these results, they've said they're going to be setting aside more money for disasters essentially going forward, and on top of that, the cost of fixing things is going up from inflation. Offsetting that, they get more from their investments. So not all bad news for IAG. It's an important company to our society, so good on them and I wish them well. But for me, look, I'd probably just prefer invest in the index than buy shares in this one.
Yep. Okay. Luke, your thoughts?
Well, my first thought looking at it is you couldn't pay me enough to be an insurance analyst because it's a result that's just all over the place, Andrew. I mean, you flashed up the profit number there, but even digging into this update, there was so many moving parts to it, non-cash items, add backs and provisions and all sorts of things, even dating back to years ago. So, it's a tough job running an insurance business. It's probably even a tougher job analysing an insurance business from the outside. You guys, Claude touched on, I think, a very important thing, which is that increasing rate of natural disasters. And these guys, IAG, have come out and said next year they've increased their provisions by 19%. So towards that natural disaster, allowances. That compares to their written premiums only increasing by high single digits. So clearly, they're anticipating an acceleration, and they've been caught behind the curve the last couple of years, particularly with the floods and then the bushfires before that. Look, I'd probably take a step back for something like IAG and acknowledge that from a accounting point of view, very difficult to analyse. But I think the one thing you can sort of fall back to is the dividend yield to a stock like this. Have a look today. It's about 4.5%. That's not too bad in this environment. It may be a bit lumpy around, certain years where they may report stronger cash profits than others, depending on, the environment we've just been talking about. But they've come through a tough period and giving that yield of 4.5%, I think is not too bad. I would hold it if you're there for that reason. If you're someone who's after capital growth, though, this isn't the business for you. I mean, at $4.20, I went and had a look at the really, really long-term chart. That's the same price it was back in 2004. So I wouldn't be in this business if you're expecting capital growth. If you're happy for that dividend yield, so sort of 4 to 5%, I would have a look at IAG as a more safe, steady option. But yeah, and hold it only if you're there for that reason, Andrew.
All right, okay. So that's summation of IAG. Let's get into the stocks as picked by you. The first one is Camplify. Raina wanting to know about this one. It is what's described as the Airbnb of recreational vehicles. Claude, I know this has been a favourite focus of yours, but let's start with Luke because it's actually a local Newcastle company, isn't it? Luke, have you actually been on board? I'm just taking a look at the share price. In fact, it's round trip. They've jumped on and they've jumped off at pretty much the same price. So over the past 12 months, how do you look at it?
Yeah, not one I've owned, but you're right. It is a local Newcastle business. Their offices are not far from me, actually, where I am. Look, the Airbnb for caravans, that's the ambition, that's the target, and if they can get anywhere near that sort of aspiration, particularly on a global level, which they're trying to do, then we'll look back at a 83 mil market cap, and it'll be peanuts compared to what this business could be. Now, of course, it's a long journey to get there. They're doing the right things though. When you look at the metrics, had a recent update in early June. The operating metrics of the business look pretty good. Rattle some off. Booking value was up. Take rates were up to nearly 29%. Returning hirers increased from 20 to 25. So all of the things you want to see for a marketplace business going in the right direction. It's not cheap today. There's no cash flow metrics in that update, but I suspect they're still burning, a few $1 million a quarter with 17 in the bank. So a bit of runway there. So you're not paying for a cheap business today. You're paying for the potential of what it could be. But as ASX participants, we know what these marketplace businesses can look like. We only have to look towards REA, Seek, car sales to see how dominant these two-sided marketplaces can be when you manage to become that dominant player and attract both sides of the marketplace to your platform. I think, as I said, I don't own this business. I would hold it if you're there because you're there for the long-term potential, and I don't think that's changing despite what's going on in the broader market today. What I would say to people who do own it or people who have it on their watch list is focus on the supply side of that equation, so getting people's caravans and camper vans onto the platform. I think that's the more difficult side of the marketplace to bring in. Even management acknowledge that. They talk about, bringing caravans and bringing supply onto the marketplace. I think the demand's more easy to capture, and they're quite adept at using search engine optimization and things like that. So far, those metrics are good. They're growing those vans on platform. As long as that keeps going in the right direction and they're building that two-sided marketplace, I wouldn't focus too heavily on short-term profitability or cash flow, because it is all about sort of building that long-term value engine that a true marketplace being. So it's a hold from me, Andrew, especially coming into a reporting season. We'll wait and see again what the update brings. But, hopefully building something really, really interesting, just around the corner here in Noumi.
All right, okay. Claude, what's your expectation, Claude, heading into its earnings results?
Well, I guess what my hope is and my expectation is the key number for me to watch heading into these results is the booking revenue. Now, so actually you're correct to say that this is one that I've really followed and I really like it. As in to follow it. I don't own it presently. Luke gave a great outline of why one should be interested in the stock, I reckon. But the key point is that I had owned these guys previously, and then at the end of last year, their stock price went bananas, and I sold mostly in December, and then I held on to some for the long term, like Luke was saying. But then in their most recent results, I was actually disappointed by them and sold after the half-yearly results. And the reason I was disappointed is because I feel like there's a little bit of diversification going on in the business. Now, I fully appreciate that they want to get more RVs onto the platform. And look, the good news in the most recent update is that that's up 60%. But in my opinion, having the distraction of then going into actually retailing RVs, selling vans at a gross margin of just 12.5%, that to me just seems like absolute crazy stuff. I don't know why they're doing that. I don't know. I could speculate, but it just seems like they're distracting management. It couldn't possibly, in my view, pay off for the salaries and the mind power that they spend thinking about that. So I would zoom in on actual booking revenue as the best read on how the actual ecosystem is growing in terms of the number of people hiring on the platform, and then of course the people coming back to do that. Now that's why I like the stock, because I think that there is a real market for that, and maybe that's a growing market, and that could be really powerful. So I sold it above current prices, but I would actually put it probably in the hold basket now. And
Yep.
To be quite frank, I could imagine myself buying at current prices if the actual results come out and they're quite strong.
All right, we'll check in with you once that happens. All right, so that's Camplify. We better jump out of the wrecked vehicle and into a sports car because we're falling behind, guys, in terms of time. Claude, let's get into Obsidian. Winnie wanted to know about this. It is the hospital software business, strong balance sheet, significant recurring revenues derived from what it's got: government, private, domestic, international hospitals and healthcare providers. What are your thoughts, Claude?
So I'll save some time on this one since I've written about it and spoken about it heaps, and I do own a small number of shares. Look, my biggest concern with these guys is that I found out not so long ago after, in their last report, half-yearly report, that when they refer to recurring revenue, they're not referring necessarily to recurring revenue that recurs every 12 months. So after I realized that, I downgraded my valuation of the company, and I've just been sitting on the sidelines. Now, as it happens, I think that it actually did get quite cheap. It was at 10 cents, which is what I've sort of said when I most recently wrote it up. Look, I think I'd be interested in buying around 10 cents. I didn't buy when it fell down there in June, and part of that's just because, look, I really want to see cash flow break even, and even profitability, and that's not slated to happen to FY 2023. So in a way, I'm willing to be patient. So I guess at current prices, I'd call it a hold.
Okay, all right, Luke.
Yeah, I agree with that. Claude and I spoke about this one probably a couple of months ago, and I was actually pretty negative on it. They'd made an acquisition I wasn't too fussed about. Not so much the operations of the acquisition, but the price they paid. I thought they really overpaid. Since then, though, look, they've announced a lot of contracts. Some of them probably more material than others, but again, it's nice to see them winning work. And the last quarterly, I think, was getting towards what Claude was just alluding to. So they reported a slight operating cash outflow. But in the notes, sort of made it clear that if you adjust for the M&A costs of that acquisition they made, they were roughly about cash flow break even. So they're getting towards that point they need to get to. Claude's right, though. This is a business I think that's a little bit more lumpy than what people think, because that recurring revenue doesn't come in steadily month by month. It's very lumpy around when they get those cash receipts. I wouldn't expect to jump in on one good quarter and the business, is smooth sailing from there. You're going to see good quarters, bad quarters, but hopefully overall that trajectory moving in the right direction from probably FY23 onwards. I think I come to the same conclusion as Claude as well. For me, it's a hold. If you don't own it, and you're sort of attracted to this micro cap space, it's definitely one to put on your watch list. It's medical technology. They're such brilliant businesses if they can make them work. So I've got it on my watch list, and if the right time, right price, or right execution came along, it's definitely one I'd be more than happy to own.
Yeah. Okay. All right, well, let's keep motoring along. The next one is Noumi. Mike wanting to know about this, saying, can you put it to our panel in a grower area of the consumer market? It's in the dairy substitute products such as soy and almond milk, and pointing out that the share price has fallen down to what recently was at got down to 14 cents, and that was after what it was at 51 about 9 months ago or thereabouts. Luke, Noumi.
Yeah, look, this is one I thought I didn't realise and thought it must have been a new IPO or something like that. It's the old Freedom Foods business, and this has been through the ringer. I mean, a lot of issues with inventory write-downs, complete recapitalisation of the business, management turnover, class actions. Well, I think they're already coming. I can see why Mick, who's written in, I can see why you're attracted to it. I went through their latest presentation, and in particular that Milk Lab business. Every cafe that I visit around town here, their non-milk alternative is always Milk Lab. They've clearly got a very good brand there, and I can see why you'd be attracted to it in that sort of space. I just think take a step back from a corporate, just history point of view, I need to see a lot more water go under the bridge for this business before I could get anywhere close to it, Andrew. In the last report, it still had negative equity. So, there's obviously things they still have to work out from a debt recapitalisation and just working through the gremlins that were under the hood from a few years ago. I get why you want to be interested in the brands they've got, but Mick, I don't think this is one you come to. You don't have to be there early in a stock like this. It'll be a long, arduous path back, given the history. So take your time, make sure that the business is actually turning. You don't have to predict it.
Yep. All right, Claude, you may well be using the products. Would you be investing in it though?
No, I'm definitely more bearish than Luke about that one. I guess it doesn't pass my board and management filters. And I guess I would say to any retail shareholder who's thinking of buying this, like, can you write me an email explaining the impact of the related party transactions since 2017 or whatever? Because I don't think that people can understand that easily. And, I note that, essentially the same wealthy investors who dominated the company 5 years ago still, as I understand it, dominate the company and have a lot of influence over it. So I think, if you look at that performance, that would be one reason to be wary as well. I'm not saying it won't go up or down. It's just that there are certain games you can say, I choose not to play that game.
Okay, so you're avoiding it at this point then. Okay, you don't feel as though a lot has changed even though it's been rebranded. All right, let's move along to MSL Solutions. It's sports, leisure, hospitality, SaaS technology provider. Recently signed a 5-year contract with Stadiums Queensland. Linda's saying it has been recommended quite a bit recently, so would love to hear what you guys think about it. Claude.
So MSL Solutions is another one that I've sold in the past. And actually, my main problem with this one is that it seems to want to be treated as if it's a high growth stock. But really, I'm not seeing that high organic growth. So in the first half, the company made about just under 17 million revenue. So based on the midpoint of guidance, revenue would actually be down half on half. So first half to second half of FY 2022. So that's fine if you're a mature business that's profitable, pays a dividend, that kind of thing. But the moment when I decided to sell my stock in this, which was above 20 cents at the time, is that when someone asked on the H1 results call when the company might pay a dividend, the CEO laughed and passed the question to the chairman, who said, "I don't believe a one-off dividend provides any benefit to anyone going forward," according to my notes on the conference call there. So yeah, basically to me, it's its growth should be a dividend stock, but it's not doing that. So I really just don't see where this fits at all in it. Just basically to me, it wants to be a growth stock and valued on revenue, but I don't see any reason to do that. So
you're just avoiding it?
I would avoid it. I'd sell it. I think that there's a lot of people that are just looking at the short-term operating leverage in the profit, and I guess extrapolating those growth rates. Don't forget, if you just cut costs to make your profit go up without growing revenue, you can't do that forever. So it's not really the growth kind of multi-year compounding growth that you look for as a growth investor. Okay, Luke, are you as negative as Claude?
No, this is one Claude and I guess we disagree on. It's come up before between us. Look, I own this in Merewether Capital, so I'll disclose that. The Suncorp and Gabba announcement that came out the other week, the company, I think it's sort of flagged that they tendered for those, and being a Queensland-based business, we're probably in the box seat to be awarded, but it's still nice to see. And Stadium Queensland, there's 7 other stadiums, obviously smaller, but maybe MSL will be front seat to grab those ones as well. I actually agree with Claude's point, though. I mean, I don't consider this to be a high growth business, so I think you've got to pay the right price for it. Today, it's about a 63 mil market cap, maybe somewhere around 12 to 15 times EBITDA. And I'm happy to grant them that because they generate decent cash behind that EBITDA metric. So it's had a nice bounce since that announcement. I think it's a hold from here. It's certainly what I'm doing with Merewether Capital. When it, during June in that tax loss selling, when it got down to sort of sub 10 times EBITDA, that's the price you would look to buy. I agree with Claude. It's not high growth. You're there for a valuation. So you'd be looking to pay sort of maybe sub 10, 11 times EBITDA max. But again, look, management, they've got ambitions to grow. I understand the sort of let's see the runs on the board before you jump in and really price them for that growth. So they've got to execute from here. We'll wait and see how they go, but it's a hold for me.
Okay, that's MSL Solutions. Our fifth stock is AFT Pharmaceuticals. Harrison wanting to know about this, saying, I want to hear the thoughts specifically of Claude and Luke. and it's saying it's a company he's never heard of before. It's likely to be in the wheelhouse of both Claude and Luke. We'll find out in a moment, saying it's underfollowed and it's in the health industry. Has recently launched over-the-counter medicines online in China, so I don't know what the growth potential is there. So, Luke, I can't say I'm overly familiar with it either. What do you? How familiar are you with it?
I wasn't, Andrew, until the list came through and I had a look. I think the main reason for that, it's a New Zealand business. So you've got an ASX listing, but it's very illiquid. It's primarily a New Zealand exchange business. And also, so be aware of that as well. As one of the points I was going to make to Harrison is, if you jump on the ASX website or your ComSec data, you'll be getting the Aussie dollar denomination for metrics like market cap and things like that. But the business reports in NZ. So just be careful if you're calculating PEs and things like that, that you use the NZ listing, I think, is the easiest workaround. But look, when I took a look, it's a very high quality business. A revenue CAGR of 14% for the last 10 years. Profits have grown steady alongside it. A list of brands in that sort of consumer health space. So it's not tied to like clinical trials in like pharmaceutical drugs, but more what you'd go and find on the shelf at your local chemist. The Maxagesic brand is actually one that I think we've got in our bottom drawer here. So brands that are probably familiar to people. It's not cheap. On my numbers, it trades on about 15 times the lower end of their FY23 guidance. That's probably a fair price. I'd definitely hold it if you're there, particularly if you're on the ASX, because it's very difficult to actually get stock and get out. So if you've got a position, continue to hold it. If you're Harrison that doesn't own the stock and you're maybe looking at an entry, I'd maybe try to get it a little bit cheaper, maybe around that sort of 12, 13 times EBITDA. And in a liquid stock like this, I think you'll get those opportunities, be that in an irrational market or even just one irrational seller in such an illiquid stock. It just takes one person to dump, $50,000, $100,000 worth of stock, and you might get a bargain on any particular day. So always keep an eye on it. It's probably just not liquid enough, or it's a bit steady, I suppose. I prefer a bit more growth, particularly for that sort of size. But otherwise, it was really interesting. I think could tick a lot of boxes for the right investor. Yep.
Okay. Claude, are you familiar with it?
Yeah, a little bit familiar with it. I've watched it for many years. Just Harrison has got knows me well. I guess there's just look at every single small cap healthcare company that has revenue, basically. And look, this is one that has always struck me as like a little bit expensive. And in that time, its share price has gone up, and the business has really developed as well. So I actually think this is a really interesting time to come to the stock because it's paying down its debt. It's planning to pay a dividend next year in FY 2023. And it's essentially got a decent quality business with brands that have some pricing power, even if not heaps. Perhaps the biggest sort of growth hope is Maxagesic, which is just a combination of ibuprofen and paracetamol. But I figure, everybody's getting sick a lot more these days. The probably demand for these tablets will be fairly strong. And, they're currently sold in, I think, 46 countries. They're looking at getting that to 90 in the next couple of years. Look, they're profitable at this scale. They should be even more profitable at a bit bigger scale. In terms of pricing, look, I think I agree with Luke's comment, but I think I'm also just at the point now where I feel like this is quite a high quality business and you could just pay up a little bit just to get a little holding. And look, I've been looking at myself. I think whoever bought shares at $3 recently did very well, but it was only trading at that price for around a week. Essentially, look, I would call it, I guess, a tentative buy, noting that I don't own shares myself. It's super illiquid, so it's one of those ones you'd only want to buy a little amount because you're effectively stuck in there. And I think the thesis would have to be a long-term compounding thesis. So, buy a little bit of shares and batten down the hatches, I think, is probably a reasonable strategy with this one.
Fair enough. All right, let's summarise where we've been for the first half of the show. Our stock of the day, IAG, with its latest results. Claude saying, well, he finds the whole sector of insurance unattractive, given the risks there. No, so from him, a hold, though, from Luke, because he says it does have an attractive dividend. The first stock, as picked by you, Camplify, a hold from Luke, saying not cheap, but it is doing the right things. Claude previously owned it, but he was disappointed with the last results, so he's looking forward to the next results to see what he's going to do with it. He's calling it a hold. Obsidian, a hold from both. And on to Noumi, which is the old Freedom Foods. Correct me, I think, Luke, did you say a hold there? I think you did but it's no from Claude. MSL Solutions, difference of opinion here. Claude, he slapped a sell on it. He recently sold it, in fact. Luke owns it. He's got a hold on it. And AFT Pharmaceuticals, a hold from Luke, and Claude, a tentative buy. All right, now the call. It is tracking its own high conviction fund, which is picked by our investment committee. The latest episode of that meeting is live for you to watch at ausbiz.com. Let's check in on the updates. And Tyro, Qantas, Frontier Digital Ventures, Tabcorp and Steadfast were removed, while Batcorp was added to the portfolio this month. We've also upped our cash holding to just over 10%. So far, our fund is 2.25% higher on a cumulative return basis since its inception on March the 1st. So keep sending in your requests, keep the call switched on to see which stocks our committee will be looking at next.
The Last Call is brought to you by AVL Wines. Invest in the home of Australia's premium wine, spirit, and ready-to-drink cocktail brands.
All right, to the second half of the show, where we'll be looking at Playside Studios, Symbio, Smart Parking, Mosaic Brands, and Sequoia Group. Let's start with Playside. Oscar wanting to know about this. Did release that game, Dumb Ways to Die, and then released a bunch of NFTs off the back of that. And in fact, last month they signed an extended agreement with Facebook and Meta with more gaming development in the works. Luke, how are you looking at Playside?
Look, it's a very interesting business, and I think you're backing an entrepreneurial management team who, you look or speak to them, and they clearly just live, sleep, and breathe gaming. They know the industry, and they're very quick to act. So take that NFT experiment you were talking about before, Andrew. It sounds interesting. There's a few buzzwords to it, but they generated $8 million of revenue last quarter, and of course there's very little incremental cost. Most of that just fell straight through to cash to the business. So, whatever your thoughts are on NFTs, and mine is that, 99% of the space is probably worthless. The management team has seen an opportunity, gone out, captured it, and brought some valuable cash into the business. Can they put an ecosystem around it and do all the other things that a lot of NFT projects promise? We'll wait and see, but nonetheless, I give them credit for it. Look, you're paying a steep price today, 250 mil market cap, and you look at where the business has come from. Like when people paid $500 million for this business late last year, early this year, that was a little bit crazy in my mind. I like them from the point of view of by far the best video game exposure on the ASX. If people sort of wanted that theme or were looking for that sort of exposure. But you're pricing in a lot of success, because primarily what this business is very low margin work for other game developers, the work for hire things they do. At this price today, they really need to smash it out of the park with their what they call original IP, where they're developing IP in-house and capture all of the value from the games that they develop. So the market got a bit excited about a game called Age of Darkness, which I think has done okay, but generated a couple of $1 million, over the last couple of quarters. It's not, it doesn't support that market cap of where they are today. So I think if you're there, I know it's a theme we've had. It actually reminds me a little bit of Camplify, to be honest. You hold it if you're there, because you're there for that long-term promise, and I think you're backing a very good management team that have sort of proven they're passionate about the space and they can, keep their fingers on the pulse and move quickly. For me, I sit back and I'm happy to watch this one and just wait to see that execution. It's also a very lumpy space, gaming. I mean, it's one of those ones where people look towards the winners like a Fortnite or a Call of Duty, where these franchises generate hundreds of $1 million over many, many years. Most games will have a spike for a couple of weeks or months and then fade away into obscurity. And these developers need to constantly keep on churning out new product to try and capture that magic again. So I sit on the sidelines for this one. But if you're there, I actually would hold it. I think you're there to back management, and they haven't put a foot wrong. I'll grant them that.
Okay. Claude?
Yeah, so I think that Playside, and that was, Luke absolutely nailed it, so I'm just going to try and add on top of that. I think Playside has traded as if like it was an ASX version of a meme stock almost, with, I feel like, just completely just about the popularity of the idea of Playside and, what new NFTs or whether it's a new game or whatever its new release is, just like trading on news flow, kind of as if the stock's reacting to like Reddit opinions more than anything else, which is fine as a trade or just as a sociological phenomena. But in terms of valuation, I completely agree with what Luke said, but I'd just also add that I feel like it's possible that a lot of people that were like talking about the stock on Reddit don't realize the real market capitalization of the company, because so many of the shares are escrowed. I think it's about 145 million shares that are traded and 260 million that are escrowed. So if you go into ComSec or whatever, the market cap will be like 90 million, but actually it's like over 250 million. So that's my 2 cents on it. Otherwise, look, it's an interesting business. I think it's kind of like Camplify in that it's in that set of money-losing stocks that's a bit more of a hopes and dreams than a profitable business. But I actually think it's way more overvalued than Camplify because its market cap's so much bigger. And look, it still loses money. And even its really great last quarter, that was more like a one-off thing. If you go back a couple of quarters, the cash flow was a lot weaker. So yeah, I would just probably avoid it, except if you wanted to treat it as like a high beta, meme stock. And if you believe that meme stocks were going to become a thing again, that might be a way to play it. But for me, I'd avoid it.
Okay. All right. Playside Studios. Let's get on to our next stop, Symbio. Jan, wanting to know about this, is a telco provider that makes cloud and software-based technology such as Communications Platform as a Service. I think the acronym is CPaaS. The company's stock losing about half its value, in fact, since November, but it's not alone there, of course. Claude, Symbio.
So Symbio used to be called MyNet Phone, and it's one that I've owned for a long time and still own it. It's the latest news is essentially that it's sold some of its lower growth parts of its business and is zooming in on being basically a wholesale provider to other companies of telecommunications. Look, the reasons I like it is it's founder-led, it has aligned management, and they have done a lot of acquisitions and disposals over the years. Not all of those have been successful, but you can see them trying to position the company to catch long-term growth and be sustainable in the telco industry. And that's the tailwinds they're trying to get onto with these app-based communications that then need connectivity to mobile phones to round out the service. They're moving into Southeast Asia, which is a reasonable strategy because they're trying to stay in this growth area. But they have a very strong and decent, profitable Australian business as well, which allows them to keep making profits even as they take risks to try and grow the business. That growth strategy could fail. That's probably the biggest risk in the short term. And, the other thing is that I actually just think that analysts have been a little bit overly bullish on this. I'm a little bit more conservative than the market has been in the short term, but I have previously overestimated it. So I actually bought shares from between $5 and then even towards the end of June, then I paid $3.60 for some shares, which is closer now to my valuation. Would be $3.60 is where I'm kind of thinking it should be at to be a buy, that is. So probably close to being a buy right now for me, but I'm just wanted a little bit cheaper just because I'm a little bit skeptical on the short term, and I want to see some success. But having said that, I do hold shares. I consider it a good long-term, decent quality business to own. So yeah, it wouldn't be terrible to buy at current prices, but my personal price that I'm aiming for is a little bit lower. Okay,
yeah. Luke, how do you look at that valuation at the moment?
Yeah, I think Claude wanted to say buy. I'll actually say buy, Andrew.
Right.
I think we're just talking about Playside and Camplify giving you growth or the real potential for growth in the future. But as shareholders today, you're taking on some operating losses and a bit of a gamble that if that doesn't happen, these businesses, may end up going to zero or get heavily diluted along the way. Claude actually, I think, hits on a very good point. I think this is a business people have probably overestimated the last couple of years. I agree with that point. Brokers were pretty bullish a couple of years ago. You see that when the share price ran up and then obviously it's come off pretty strong. And I think that growth's been a little bit behind where people expected, particularly into that Southeast Asian region where they've been focused. But take a step back from that. You've got a very profitable core business. On my estimation, about 10 times EBITDA, I think, is a very fair price. And all the cash that comes along beside that, they have more than 100% cash conversion. So it's a true EBITDA compared to some of these businesses that capitalise costs, in the background. So for me, I think you're paying a pretty fair price just for the core business, assuming that nothing else changes. You get a bit of a free option then at the growth, where they are spending about $5 million a year to go into Southeast Asia. Early signs are okay. But go back to Claude's point. I think the thing that really gives you some, sleep at night protection is you've got two founders in the business who, through many, many years, have proven that, they will look after the interests of shareholders because they are, large shareholders themselves. So I back them to, if that growth in Asia doesn't come through like they planned, they'll step back. They actually came out last report and said they pulled back from an acquisition because it was going to be too expensive for them. So, I take the protection of a core business spitting out a ton of cash, the optionality of growth. I think it's a pretty low risk buy at these levels, pending, of course, market could do what it do. But from a standalone stock, I think it's very attractive, sort of around this $4 level.
Okay, all right. A low risk buy from Luke. To smart parking, Zoe wanted to know about this. It is a global provider of tech, hardware and software for parking solutions, which enables what's automatic number plate recognition, which certainly I find it easier when you go into a parking space and you don't have to fiddle around and lose your ticket and so on. So that certainly makes it easier. And Luke, I know you've been all over this in the past. So what's your latest reading on smart parking? Nadine had us on a couple of weeks ago and said bring some positivity amongst all the negativity, and this was the stock that I brought. So I'll keep it brief, Andrew, because I've actually got a write-up on merewethercapital.com.au. So Zoe, who wrote it in, feel free to jump on the website. There's a blog post there that sort of outlines smart parking. And I've recently bought at these prices. I believe it was around 18 cents. So I think it represents pretty good value and similar to my Netphone. I think you're getting a business there today that's quite cheap. On my estimates, about 5 to 6 times EBITDA, but a ton of cash flow that comes in behind that. And so the optionality of growth, which management so far are executing pretty well on, particularly here in Australia and looking to move into Germany as well. So I think it's definitely still a buy as more of that sort of low risk, but the optionality if management can execute. That's sort of the investments that I like to find. I'll say buy, and if you want that more in-depth analysis, Zoe, jump on the website and have a read. Yep, know where to find that. Claude, do you agree?
Look, I think I do agree. I don't own shares myself, but ever since Luke's wrote it up and he's also told us about it a couple of weeks ago, I've had a look at it and it looks pretty good to me. So I will call it a buy. I haven't finished doing my own due diligence on it. Now, the reason that I'm hesitant, the reason that I'm sort of taking my time to think about it is because this company has actually been listed for quite a long time. And to my mind, it's like there's sort of almost 5 years of sort of failure to fire for me to reconcile myself with. So with these kind of businesses, I do like to go back and have a look at, understand the history and need to understand why it's really going to be better from here. In the short term, look, I think it's fair to say they were hit really hard by COVID. And so to a degree, this could be seen as somewhat of a reopening play. Now, with the thing, there's also some threat that I guess their business model could be too harsh on consumers with parking fines and stuff like that. So there's a regulatory risk that Luke has highlighted in his outline. Look, I don't know that high parking fines really should be or are the highest priority for regulators. So, that could happen. Maybe you want to have a look at see how the business operates under new circumstances that are supposed to were originally supposed to take effect in 2023, but that's years away, and the business may have completely changed and become more profitable by then. So that's why, keeping in mind the risks and keeping in mind that I haven't bought shares myself yet, it is one on the top of my list. And for the purposes of this show, I'd probably call it a buy as well.
Okay, we like that. Good one. All right, we better lift the pace as we move to the end of the show. The second last one, Mosaic Brands, the largest specialty fashion retailer group in Australia. You'll be familiar with some of the brands: Miller's, Rockman's, Noni B, Rivers, Katie's. Louis saying, interested in your view on it. Has the market cap been unfairly beaten down following a few negative trading updates over the past period, or is this just an example of an old school retailer not sufficiently moving with the modern times? Claude?
Look, these old school retailers that don't move with modern times can have a lot of operating leverage in their business. They can go in and out of trend. They can have a few good years and a few bad years. And it's just a massive roller coaster that I mostly choose not to play. I like to look for some sort of secular tailwind in my investments, especially ones you'd consider high risk, which this is high risk. So yeah, for that reason, I'd sort of say more like, I don't think there's any secular growth tailwind reason to buy this. Like, it's just a matter of, it's overvalued now, and maybe the market's going to correct that and I'll sell at a profit. That can happen with these kind of but these kind of very distressed companies that aren't on a good secular growth path. But for me, I just try and avoid them because they're really tough places to play, basically.
Yeah. Luke?
Look, further to that, I'll give you a brief timeline of this business. So at the end of the second quarter, they actually reported a decent profit in that first half, had 32 million debt drawn. Things have really gone off the rails. So at the end of the third quarter, they'd drawn an extra 15 mil debt, then put out a weak market update and said that they expected a full year loss after a 14 mil profit in the first half. So, second half is at least a 14 mil loss, if not more. We wait and see exactly what it turns into. 2 weeks ago said they wouldn't pay cash interest on one of their convertible notes. They're going to capitalise the interest rather than pay cash out of the business. I suspect this business as an equity listing doesn't have long left, and I would probably say a very strong sell to anyone who's in there. This is looking like it'll be recapitalised, and you'll be diluted a long way down because it's a 21 mil market cap with 47 mil debt and some convertible notes on top. So debt holders control this business right now. The share price reflects that. So I wouldn't be there, Andrew.
All right. Okay. So perhaps if you do own it, you need to act. Finally, Sequoia Group. And in fact, Bell wanted to know about this one. It's an integrated financial services provider. You may be familiar with Finance News Network, which it owns. Luke.
Yeah, look, a bit of disclosure around this one. So I own it in Merewether Capital, but I've actually recently trimmed it a little bit. One of the reasons why is because it's held up quite well in the market downturn and become a bit of a larger weight for me. But the other reason is I'll take a step back. So a large chunk of their business is services to financial advisors and accountants. That's actually quite a defensive business. And so a big chunk of the revenue and earnings, I think, will be fine. But there is aspects to this business that are tied to the cyclicality of markets. And the main part they have there is a corporate advisory business that obviously generates fees on IPOs, placements, capital raisings, things like that in the market. That's been a pretty tough space since the start of the second half of 2022. These guys are nowhere near the size of Goldman Sachs and the big banks in the US. But if you have a look at those big banks in the US, the one part of their business that's really suffered in the last couple of quarters is that capital markets exposed segment. So I still own some Bell, so I'm not completely negative on the business, particularly that valuation. For me, trades on 6 or 7 times EBITDA. And again, come back to that same theme with Symbio and Smart Parking. It's the cash generation that comes in behind the EBITDA. That's what you're always looking for. So from that point of view, look, I still think it's very cheap. It'll become a bit of a bigger weighting for me, and just be a bit wary that it does have that cyclical nature. It's not as defensive as maybe what you first think, just looking at purely at that services business to the financial planners and accountants. So I guess I would say a hold, Andrew, but that disclosure that I have actually taken a little bit off for the fund.
Yeah. Okay. Claude?
Great insights there. I agree that the short term is probably looking a little bit rough. This is actually one I hold as well. Look, yeah, you got that situation where it's buying back shares. I would say, I think that for me personally, I'm probably overexposed to some of these, this industry generally. But so it's funny that I'm like investing in it with my portfolio as well. But look, I admire what these guys have built. Been watching them on the market for many years now. It's can be a tough industry with advisors leaving the industry, which isn't really good for them, and it's a bit of a struggle sometimes. But something needs to fill the void that's been left, and these guys are there, and they're trying to get scale, and they're knitting together various parts of the vertically integrating in a way in the financial advice industry. And so, given that they can take advantage of a low share price by buying back shares, I do quite like them myself. Luke's given me pause there because I agree with the short term, but I think in the long term, if you took a long-term view, I would actually say it's probably a buy. I think that these guys will be a much bigger company in 5 years. It's just that path that they take there, if we do go through a recession and stuff, then this is one that I would expect probably to get hit quite hard.
Yeah, okay. All right, well, let's summarise the second half of the show then. Playside Studios there, Luke saying, well, he's saying it's the best video gaming exposure you can get on the ASX, but he's got to watch and hold on it. But Claude is avoiding it at this point. Symbio, Claude owns it, but he's watching it perhaps as a buy, and Luke calling it a low risk buy. Smart Parking, Luke saying good value. He also owns it. He's got a buy on it, as does Claude, as he calls it a reopening play there. Mosaic Brands, conversely, Claude saying very high risk, avoiding it, and Luke is slapped a sell on it, saying the company's essentially in its dying days. And Sequoia Group there, a hold from Luke. He owns it, but he's trimmed it, and Claude, he owns it, calling it a long-term buy. All right, that is the show for today. Claude, thanks for joining us for Reach Live.
Thanks for having me.
And Luke, as always, thanks for joining us from Merewether Capital.
Thanks, Andrew.
All right, any stocks you'd like us to cover, flick us an email to call@ausbiz.com.au, or you can tweet us at ausbiztv. And a reminder, you can find those stocks we have in the calls portfolio. Head to ausbiz.co/portfolio. Stay with us, much more to come.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
So everything that's digital becomes an opportunity or a threat vector.
Really being able to corral and focus people, particularly when an incident is happening.
Join me each Friday at 2 p.m, where we'll ask the big questions to the country's top cyber experts. Stream on ausbiz.com.au or on demand.
Managing your own super used to be complicated. Not anymore. With Stake Super, signing up for your SMSF takes 3 minutes and not a single piece of paper. Once you're set, you can invest your super on the ASX and Wall Street, right on the Stake platform. But leave all the admin and accounting to us. That's included in the annual fee of just $990. Take control of your super with Stake Super, Australia's most hassle-free SMSF.
The Pulse is brought to you by Zerilio, cybersecurity experts protecting Australian businesses and organisations so we can all be safer together.
The Small Caps is partnered with the Australian Stock Report. Looking to make better investment decisions? Visit australianstockreport.com.au.
Hello and welcome to the Small Caps. I'm Andrew Gagan. Today we'll be chatting with Dr. Christian Berenbush, the Chief Executive of Telix Pharmaceuticals, after the company's latest market update. First though, let's check the market, see how we're performing on this Friday. And as we can see there, we've actually bounced back into positive territory. The Symbio 200 up close to 0.5%. Just in terms of the small caps there, and the ETFs, the Vanguard Australian small caps, are all looking positive in today's trade. And some of those that are moving specifically, we can see there, 4D Medical up over 17%. Tambourine Resources there up close to 12, along with IPD. And at the other end of the scale there, Aurelia Metals suffering today, off over 9%, along with some of the other companies in the materials space, plus in the energy, Aura Energy there, also down. All right, so let's get the lay of the land and check in with Henry Jennings from Marcus Today for his take on the space. Henry, g'day. Always good to catch up with you. So how are you looking at the small caps at the moment? The broader market looking very positive. I think we're up more than 3% for the week. What's happening at the lower end?
Yeah, hi Andrew. I think we've had a bit of a Lazarus-like recovery from those dim and dark days back in the June or sort of midwinter, I guess, around the longest day. It certainly was, or rather the shortest day for our market, but it was, since then, July has been a pretty good market for small caps, I have to say. You know, you've got the All-Tech Index here up around 15% in July, and we're not done yet. It's 22nd of July. So we have had some big bounces, the likes of Zipco. You know, that's bounced from 45 cents back up to 90. It's a two-bagger in a month. So there's been some extraordinary moves, and I guess, you know, when you look back on history, when we do look back on this period of time with this rise in interest rates around the world, it may well be that June shortest day around the 20th, 22nd was the bottom. Who knows? But certainly, you know, the risk appetite has returned. I'd like to say that the volumes have returned, but I think a lot of people have been battered and bruised throughout this experience. They may have chucked in the towel during that June period. And of course, a lot of people were short as well. So we have had some short squeezes, not least of which I suspect Zip is part of that short squeeze. But certainly there is some confidence. There is a bit of a spring in the step of the small cap space at the moment. So that is a welcome change from what we saw in June, that's for sure. Yeah,
probably also where, you know, in June we saw crystallising those tax losses at the same time. But of course, a lot of this relative. I mean, you mentioned Zip, but given it's fallen so far, you've done well, obviously, if you bought down the bottom. But if you've been holding from the top, then not so.
Well, I guess if you've been holding from the top, you haven't been reading the signs along the way, have you? And that's, you know, that's not a great part of a trading plan, is to see that absolute cataclysmic fall in the stock price. But equally, you know, for those coming late to the party that have waited for a turnaround, a catalyst for the turnaround, and certainly that business update that we saw in recent days does seem to have been a catalyst for a bit more of a kick again today. Certainly there's things happening out there, and I guess, you know, the big catalyst for Zip was the abandonment of the Sezzle deal, which really didn't really make a lot of sense. You were buying an ugly duckling and trying to make it into a swan, and that always is prone to problems, I'd have to say. So that was probably the big catalyst. As soon as it abandoned that and started to cut costs and start to look at bad debts and cut those down, that does, they've still got good leverage. They've got a big pile of cash as well. At one stage, they had more cash than market cap.
Yeah, absolutely. All right, Henry, let's take a look at some of those stocks that are on your radar at the moment. AVE Group, or AVE, or the ticker code IGL, it's all a little confusing actually. It's the media and printing firm. What are you seeing here? Because what I gather, what a competitor has gone bust, so that's been of benefit.
Yeah, it's funny, there's a bit happening in this space. We had Woolies this week bought the Shopper Group, which is more digital marketing and advertising. The guys at IVE Group, which is a little bit thin on the ground in terms of trading, so that's a potential problem with this one. But I wrote this one up on Monday as a buy around $1.70, $1.75, and they're up about 20% since then. So clearly that struck a bit of a chord. I know that you guys had them on one of your programs during the week as well. And one of their competitors, Avato, has gone under now. You'd imagine that some of that business is going to go towards the likes of the IVE guys, which is emerging as the biggest sort of behemoth in the sector. Not only do they print catalogues in old school terms, they took over the Salmat distribution network. So, when you get that Coles or Woolies catalogue in your letterbox or your Officeworks or whatever, these are the guys that print those. But they also do a lot of digital marketing as well, and digital catalogues through a business they have called Lasso, which they're rolling out, and that's sort of Lasso 2.0 coming. So it stacks up on. I know that it's it's dinosaur kind of technology to some extent. You look at print media and you think, we've not done that. We're now much smarter about things. But whatever happened to the paperless office? We still haven't got that. We still, human beings still actually like to see things on paper. So despite the fact that the death of catalogues has been greatly exaggerated, I suspect. So this one for me, I think it's still got more upside potential, and they're certainly moving into the digital space as well, which is a positive, and it's got a very nice yield too, fully franked yield. So that is another positive for this one. So I don't mind this one at all.
Okay, all right. The next one you're looking at is National Tyre and Wheel, and I guess this is about looking for positives out of the negatives, because your point is, given the amount of rain we've had, certainly on the East Coast, and I know so many people that have had to change their tyres because of potholes, not just tyres, but actually the wheels, which is incredibly expensive. So potentially this company is going to benefit.
You'd think so, wouldn't you? I mean, this was one that caught my eye this morning because there was a report in Fairfax about the number of potholes. And I know if anybody's been driving around Sydney where I am, you can lose a car in some of these. They're enormous. And, you're spending your life dodging these potholes, which is fine and dandy to some extent during the day when you can see them. But at night, when there's a bit of wet on the road, you can't miss these things sometimes. And National Tyre and Wheel, which has got a bit of a growth strategy through digitization, warehousing, etc. They've had a takeover. They've also raised some money as well. It's one of these stocks. It's only a $140 million market cap. Doesn't get much coverage. Doesn't really talk to the market much. But it is off those sort of June lows of under $1, sort of 94 cents. Here we are at $1.05. It is thin on the trading side of things. But my Mark 1 eyeball, anecdotally, and as you say, Andrew, you've seen this with friends, these guys must be doing pretty well at the moment. And the rain is not stopping, and the potholes are not being filled. So, to me, this one looks like one of those slow burn stocks. When it does report in August, we could see the beauty, I guess, from these guys' point of view, of the pothole, which not so much beauty for those people that own cars that disappear suddenly into one of these potholes, that's for sure.
Indeed. All right, Henry, let's move on to a sector that we've often spoken about, one of your favourites in lithium. Quite a few updates coming to us. In fact, Ioneer, the latest, just as far as striking that offtake agreement with Forward. I know one of your favourites is Liontown. What are you seeing there at the moment?
Well, Liontown is one of my favourites. These guys have got a pretty big project, Kathleen Valley, fully funded, and they've also been doing the obvious offtake agreements and some pretty good ones as well, Tesla amongst them. So they've also announced the contractor for Kathleen Valley. And when you look at the valuation at the moment and you look at where the actual price of lithium is, the market is building in a very, let's say, conservative, but I'd say very aggressively conservative downturn in the lithium price. Because if you put in spot prices at the moment, or even sort of what you're going to hope for in 2024, 25. This thing is massively undervalued. And I added to this in our small cap portfolio recently around the $5 level, and it has been going pretty well. So I'm very happy with this one. I'm very happy to nibble away at some of these lithium stocks. It does seem to be that the sort of the downturn and the optimism is back a little bit in the sector. All that pessimism we saw in June, which was coupled with a lot of stocks as well, and it did sort of manifest with that. I think it was Goldman Sachs from memory that downgraded all their lithium and said the lithium story is dead. And then you've got Elon Musk coming out the other day and saying it's basically a license to print money. So somebody's right. I'm not sure I'm going with Musk on this one, but certainly there is a lot of potential still, I think, in this sector, especially for near-term producers and current producers as well, the likes of Pilbara, Alchem, etc.
Yeah, no surprise. Elon Musk would say that, of course, in his interest to see that price fall. As he said, it's way too expensive at this point, but then they've got no choice in terms of buying that stuff to make their batteries, to make their cars. Henry, exactly. Gold, that sector has been absolutely battered recently, of course, with the gold price coming off. So are you seeing opportunity there at the moment?
I've got to say, Andrew, I am. I'm having a little bit of the nibble. I am having a little nibble in places in the gold sector. It has been battered and bruised, but every dog, as they say, has its day. And this one, we did see a bit of a perk up in the gold price last night. And part of the reason why the gold price has been under so much pressure is the strength in the US dollar. There has been money flowing into the US dollar, defensive money, because there's nowhere else for it to go. People are worried, risk off, etc., going into the US dollar. We are seeing signs that the US economy is slowing even a smidge, and the US dollar is coming under just a tiny bit of pressure, and that's helping the gold price. But what's probably more important, I guess, is that this is an opportunity for those that have got strong balance sheets, that have used the strength in recent years to raise money, to actually start to acquire some of the lesser players, some of the weaker players. And sometimes it's far cheaper to actually acquire a company that's already got a prospect or a JORC resource than it is actually to go drilling yourself, especially bearing in mind the logistical problems that we've seen with drilling in terms of getting staff, getting drill rigs, etc., because it's pretty busy out there. So I think there's a bit of consolidation. We're seeing it with Dacian at the moment, which is under takeover from Genesis Minerals, where they're kind of putting the band back together in the Leonora mine field in Western Australia, so the gold mine's there. So that's Riley Finlayson, who is doing the work there. He's ex-Northern Star, ex-Saracen, so certainly a very big quality management team that he's assembled there. And for me, Dacian I bought them the other day for the portfolio, was just a kind of a backdoor way into buying Genesis at a bit of a discount. And we've had a couple of upgrades from Dacian as well. De Grey is also another one that I've been looking at. And again, that was a stock that I added to my small cap portfolio the other day at around 75.5 cents. Just got too cheap. And these guys, I know everyone gets tied up with the gold price, but these guys are gold explorers. They're yet to actually produce anything. So it's more a sentiment thing and looking out into the future.
Well,
so
yeah, mind you do have to be careful even with the producers, with because I was mentioning Aurelia Metals a little earlier. It's just out with its latest report on lower production, higher costs, and it's been slammed as a result.
That is what's been that's certainly the feature of the sector at the moment, is that lower production, whether it's through rain, whether it's through staffing or COVID issues, and those higher costs because of diesel costs, fuel and energy costs, and also flying people in, paying them more. So that is certainly the feature. That was what came out of the evolution update that we saw, which kind of triggered these downgrades. But as I say, Andrew, every dog has its day, and I think there are some signs that maybe we're going to get some consolidation in the sector. Maybe it is bottoming. Could be too early, but I'm having, as we say, a nibble.
All right, enjoy that then. Henry, always good to catch up. Thanks for joining us from Marcus today.
Thanks, mate. Have a great weekend.
All right, let's get into our small cap of the day. It is Telix Pharmaceuticals, just dropping its fourth quarter results with revenue spiking thanks to global sales of its Illuccix drug. Chief Executive Dr. Christian Berenbusch joining us now for the details. Christian, thanks so much for taking the time to talk to us. So obviously you're very pleased with that result, particularly the performance of your Illuccix drug.
Yeah, though definitely, it's been a successful quarter. It's our first quarter of booked revenue for the United States. It's also a quarter prior to reimbursement. So our reimbursement in the U.S. became effective 1st of July. So it's really just the beginning of what we expect from this launch in the U.S.
All right. So when you talk about the launch, so what, you've got approval there. What's the addressable market you're looking at?
So prostate imaging in the U.S. is about $1 billion addressable market. It's a relatively new medical opportunity, big unmet medical need. And so, the timing of the launch of our product is really important from a patient perspective.
So, and you'd expect that to grow, given it's all about the treatment of prostate cancer. Just tell us then what it actually does and just the expectations for growth there.
Yeah, so our product has two indications. One is for men before they go and have a prostatectomy. It's to localize the prostate cancer so that the surgeon is able to properly resect the patient. And the second indication is for men that have had a prostatectomy, and there's a blood test called a PSA test. I think many people are familiar with it. And when that number starts to rise, it's a sign that there's a little bit of prostate cancer somewhere in your body. But until now, it's been very difficult to localize. So what we do is we provide an injection that allows the patient to be imaged to find that little speck of that grain of rice size of prostate cancer, and then give the surgeon or the oncologist some fresh options to manage that patient. So about somewhere between 200 and 250,000 patients a year in the U.S. We have approval in other countries, including Australia, and we've got plenty of more approvals along the way. But the U.S. market is a big one, obviously, for this product.
What's happened with, when you're in that field, particularly the treatment of prostate cancer, what happened over COVID and what's the way forward? I mean, obviously that's still having effect, but clearly when you look at the treatment of other diseases at the moment, I guess it's back on track, isn't it?
It's a great question, actually, and thank you for asking it. COVID deferred a lot of surgical interventions that were not necessarily time critical. And one of the things about prostate cancer, it's a fairly slow growing cancer. And so surgical lists were backed up a fair bit coming out of COVID. And that, of course, now gives us a bit of tailwind into our product launch, because there's probably another 60,000 patients or so that are looking for better surgical management. And that does feed into the uptake of our product. So, part of the strength of our quarter is really the inherent incidence of prostate cancer, but also a few reservoirs of patients, and the COVID reservoir is one of them that really gives us a bit of tailwind for the product launch.
Christian, how well capitalized are you at the moment?
Look, we did a raise in January. We were very fortunate that it was timed at the sort of the precipice of the market environment that we've seen the last few months. So we raised 175 million at 770, and of course, like the biotech sector overall, we've had, I would describe it as a colorful 6 months. But I think there's also been clearly this event for the company on the horizon, and to be able to deliver it to shareholders has obviously had a pretty profound effect in terms of getting back to the valuation that we think the company sits comfortably at. So in our last 4C, we reported in excess of 120 million of cash on the balance sheet. We've been very judicious about our expenditure, particularly in uncertainty. You want to be sensitive to cash preservation. But as we go through this transition period and this commercialization effect, obviously that gives us the opportunity to recharge our balance sheet and move towards a more sustainable commercial model for the company.
And what's the focus then going forward? Is it on Illuccix? And are there any particular risks you're seeing there, I guess, particularly when you consider what's going on in the broader macro backdrop?
Look, we're in good shape. The U.S. market for our product is very strong. Obviously, the strengthening U.S. dollar, per the previous discussion, it certainly does help us because we have still a fair bit of expenditure in Australian dollars and euros. I guess that would cover about 2/3 of our workforce. So there's a natural hedge built into our business from a forex perspective, and we expect U.S. revenues to continue to grow considerably over the next few quarters. And I think that we've got a phase 3 trial that we just completed for our follow-on product. It's a renal cancer product that goes to the same customer base as Illuccix. So the investment that we're making into our sales force and our commercial activities in the U.S. and also in the European market then serves that second follow-on product, which will read out later in this quarter. So it's not just sit around and wait for the first product to sell. We're actively expanding indications for the first product, and we've got a second product in the wings that will go to market fairly soon as well.
Christian, thanks so much for the update from Telix Pharmaceuticals.
Thanks so much. Appreciate it.
All right, that's the show for today. Small Caps. Join us again next week for much more in that space. Stay with us though. Cracking Crypto is coming up next.
The Small Caps is partnered with the Australian Stock Report. Looking to make better investment decisions? Visit australianstockreport.com.au.
These days, investment advice can come from anyone and anywhere. But the right advice for your stock investment should only come from a trusted and reputable source. With our popular income report producing an annualised return of 14.9%, the Australian Stock Report lets you speak directly with a product consultant that will guide you through the range, so you can select the research products that are right for you. No more stock tips from your next-door neighbour. No offence, Trevor. The Australian Stock Report, a trusted source of information.
Watch on demand, listen to the podcast, or join me live every weekday. It's The Call, exclusive to Ausbiz.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Did you know that over 80% of trades can occur outside of normal trading hours? Opportunity doesn't wait. Trade more than 70 key US shares 16 hours a day this earnings season.
G'day and welcome to Cracking Crypto on this Friday. I'm Andrew Gagan. Great to have your company. Let's check the market, see what's been going on. Bitcoin's price remains stubbornly close to that 50-day moving average, but has yet to break above it. You see, hanging on around 23,000 US. Ether's price, by contrast, remains above the 50-day moving average. It's seen some very impressive gains, certainly over the past 7 days or so. Now, in the latest news, crypto exchange ZipMex has confirmed that it lent money to the troubled crypto lender Babel Finance and Celsius. And according to the company's Facebook post, ZipMex's current exposure to Babel is $48 million, with an additional $5 million to Celsius, which did file for bankruptcy last week. And in the States, the Securities and Exchange Commission says 9 coins traded on Coinbase are unregistered securities. The accusation came as a Coinbase ex-employee and his brother and a friend were accused of buying tokens before they listed on the exchange. Meanwhile, Coinbase has filed a petition to the SEC criticising the current state of cryptocurrency regulation in the US, saying that without effective regulation, the US will fall behind in digital asset innovation. Let's venture into that space and what's been happening there to take us through it and the institutional adoption of digital assets. Mark Curiot, Head of Business Development, OSL in Australia, joins us now. Mark, good to see you.
Thanks for having me.
Yeah, there's so much turmoil in the space at the moment, particularly as far as those exchanges are concerned.
Yes.
Has that come down to the lack of regulation?
I think crypto is a relatively new asset class and it's going to have cycles like any other. What you're seeing here, I think, is a deleveraging and sort of changing of the guard. You're going to see firms that aren't well run, that don't have good risk management processes, etc., given their immaturity potentially, and they've sort of been carried out and moved out. So regulation is important, and I think that's going to be a driver for mass adoption. At OSL, where I work, our DNA is regulation and compliance, and so we hope to come out stronger from this turmoil of the last few weeks. But yeah, regulation is definitely something that's needed in order to this industry to sort of mature.
Yeah, well, that's obviously what a lot of retail investors will be looking for at the moment, given so many have been burnt. So just to tell us then what you're doing at OSL and in terms of also your licensing and the fact that you're insured at the same time.
Yeah, sure. So we as I said before, our DNA is regulation and compliance. The firm was built to face regulated counterparts in a regulatory, strong environment. So that the clients that we have are all institutional by nature. So regulated banks, regulated brokers, that kind of thing. So we were the first firm globally to get SFC license in Hong Kong, Type 1 and Type 7 for digital asset services. We're being grandfathered in Singapore under the PSA. So there's different licensing regimes everywhere in the world, and we are trying to make a company that can work in the different regulatory environments. The clients we speak to are all institutional, and we provide a variety of services to them, whether that's brokerage, custody, etc., etc. So we're just really dealing with the big end of town.
So that comes at a time, obviously, we've seen that contraction in the retail space. What is the appetite then among institutions at this time, I guess, when so many of the assets are depressed, but also you've got so many projects going on at the same time in the background?
Yeah, well, so as I said, we're laser beam focused on institutions. I can tell you that the development is moving ahead unabated. So whether that's banks, brokers, fintechs, they're all building the pipes to participate in the next elements of this cycle. The name brand banks globally are trying to build, wallet custody infrastructures. Brokers are trying to add this asset class into their platform to allow their customers to trade it. You're seeing adoption across the institutional curve. As I say, the jitters of the last few weeks they haven't blinked at this, and we're seeing this. We're being inundated with requests from institutional professional investors in accessing this market and building technology to